You unless you're talking.
Okay. So I'll wait until you introduce me.
Yeah. Hi, Minnesota. This is Christie Thompson with Christie Legal, divorce and child custody, paralegal, and mediator. And it's time for the weekly Facebook Live event about divorcing. And as usual, it's not going to be all about the law because there's more than the laws going on when you get divorced. We are also going to talk about mortgages. And I have Matt Mintz from Executive Mortgage with me today. And he is going to talk about mortgages in general. And then he's going to share some case studies of people who he has helped obtain mortgages during or after the divorce process. So, first, to give you a little bit of information about the legal parts of divorcing. Um, and as a reminder, if you have any questions about anything that Matt or I say, please put the question either in the chat box or Facebook message it to me or text it to me. Any of those ways works. And so when you are divorcing, the first thing that everybody needs to do is divide the marital assets. A marital asset is an asset that was accrued or purchased during the marriage. So that includes all the money in your financial accounts, including your retirement accounts. That includes cars, houses, all the stuff in your house. So the important thing to know is a marital asset is not something that you had already had before the marriage. So if you had funds in your retirement fund or your investment account or your bank account before you married, we would subtract those out. If you owned a car before you were married, that is not a marital asset. The house is a special deal that has a lot around it. So you'll have to schedule a free consultation to learn about that. But if it was not purchased during the marriage, if it was purchased before the marriage, then the other party is not entitled to half the equity, but some of the equity. So we are going to value all the assets, and I'm going to pull in other professionals to help us do that. So the house, we're going to rely on either an appraiser or a real estate agent. I have a lot of real estate agents who are willing to give my clients free market evaluations. However, if you're going to refinance the mortgage within the next couple months, then an appraisal would be the right choice. We're going to value the automobiles using Kelley Blue Book. We're going to value the financial accounts using a financial advisor. If you don't have a financial advisor, I can refer you to several who I think that you might build good rapport with. We could value the financial accounts without an advisor, but it's highly suggested that you use an advisor. So then after everything is valued, we're going to create a marital asset spreadsheet and put whatever in one person's column and one person's and the other person's and the other person's. And then we're going to see how that shakes out. And that will tell us, how the assets that are jointly owned need to be divided. The assets are puzzle pieces, and we move around those puzzle pieces until each person is going to walk away from the marriage with about 50% of the assets. Now, you folks might agree to not, go the traditional legal route in the state of Minnesota and divide the assets 50-50. And then we will divide those assets in the way that you folks both agree to. Then we will divide the debts. All debts that are incurred during the marriage are marital debts: credit card debt, medical debt, tax debt, everything, student loans, anything and everything. So it's very important that we divide those debts so that, 10 years from now, you're not surprised because you are now a debtor on your ex-spouse's credit card and you're getting collection letters. So after we handle all the financial stuff, if you folks have children, then we talk about all the children things. So where are the children going to be at all times? Who is going to be making decisions for the children? Medical, dental, mental health, education, and religion. Um, where are the children going to go to school? Um, lots of different things to decide. When I work with people, I ask them to reach agreements on the fine details of co-parenting because now is the time to do that. When people are getting along a little better, um, they could get along a lot worse moving forward. That is why I'm sure you all know somebody who, is in court every 2 years fighting about some child custody thing. If they had had a solid set of divorce and child custody case documents to begin with, they, in all likelihood, would have been in court a lot fewer times. So I ask my clients to reach agreements on things such as, are there sports that the kids are going to participate in or they're not going to participate in? How long are you going to wait until you introduce your children to a new partner? Lots of things that can become litigative that we can hopefully um, plan for right now. So that is a little summary of the legal stuff that people handle when they divorce. And I'm not seeing any questions. So we will just launch it right into Matt talking about mortgages. Um, Take it away, Matt.
All right, thank you, Christy. Appreciate the opportunity to speak with your audience again today about mortgages and divorce. I've been through it myself, and divorce is not a fun time, even if you're going down the mediation route. Tempers and feelings can get high, and people want to lash out and grab what they can. But handling the house and that large of an asset methodically is really critical to get preserving the value of it, and that's what everybody wants. So keeping the house in, so if the goal is to keep the house, keep for one of the spouses to keep the house in a divorce, there's a few things that you need to keep in mind. I mean, obviously one of the approaches to dealing with the house is just to sell it and split the assets. But if keeping it is on the agenda, there's basically three questions that need to be answered. Who owns it? Who owes on it? And how, the equity, how is it valued and split or paid out? So who owns it is whose name is on the deed. Now you can do a quick claim deed that removes somebody immediately from the title, but it doesn't remove them from the note or the mortgage. And that's where it's decided who's owes on it, who's on the loan, and how do you get that other person off? And then the third question is the equity. That's something that you would determine with your mediator or divorce lawyers and financial planner to how that's handled and how it's paid out. So for the deed, who owns it? As I said, signing the deed over doesn't do anything to the loan. And the way to handle the loan is there's a few options. You can refinance it, and the law provides for you can treat it as a rate term refinance when you're cashing out another spouse, so you're not paying a higher rate for cash out refinance. Or you can do, if the loan allows it, you can do an assumption. Now, this is true for VA loans and FHA loans and some other loans. To find out if your loan is assumable, you need to contact your servicer. Also, it will say on the last page or second to last page of your closing disclosure whether or not your loan is assumable. Now, what assumable means is that someone else can come in and take over the loan where it stands with the outstanding balance, the rate, and all of that, and the terms, and the remaining term on the loan. Now, you still have to deal with the value on top of that. If you're cashing out a spouse who's buying the property, you still have to deal with the equity that you're going to be transferring to them, and that would not be part of an assumed loan. You need to find another mechanism for exchanging that value. And the question, how often is a mortgage loan assumable? It really depends. It depends on whether it's allowed or not. The biggest thing there's two questions on an assumable loan. Do you want to do it? Sometimes it doesn't make sense. If rates have dropped, there's no point in taking over an assumable loan, or there may not be. The advantage of the assumable loan is that you don't have closing costs. So you're not having to pay commissions, you're not having to pay a bunch of fees to a lender or taxes. Well, there shouldn't be any tax, a little bit of title fees perhaps, but you're just assuming the loan, you're removing the other person. The let's see. The question for an assumable loan is, can you qualify? Whether you're selling the house to an outside party and they want to assume the loan, or one of the marital partners wants to assume the loan, they have to qualify. And that's going to be by, do they have enough income? Do they have debts low enough to their ratios are still qualifying for the loan? If they're not, then you run into an additional problem. And that's why it's important to speak to a mortgage person, a mortgage loan officer, in the process of your divorce, so that you create an outcome in your divorce decree that is actually underwritable. If you wait too long or don't address it beforehand, you may end up with a situation where the decree says an outcome that you both agree on. It's like, that's great, but it's not doable, or may not be doable within a reasonable period of time if you have to sell the house or find alternative financing opportunities. So the question, can you qualify a loan? You're now looking at only one income house to cover the whole payment. The support, if you're staying in the property and owe support, that support is going to count against you. If you're staying in the property and receiving support, you can use that support to qualify, but there are restrictions around that, in that it has to have been occurring for 6 months or so. Something you want to take into account before you do that. Another factor is if there's been credit damage, that can raise your rate. And if there's a buyout, that means a bigger payment. So that's in the case of a refinance. So if you're refinancing and getting cash out to pay out the other spouse, that's going to bring up additional funds. Christy, do you have a question?
Well, so I really want to encourage everybody to do exactly what Matt said and meet with him, or, if you already have a mortgage lender, before you start making ideas on how you are going to divide the assets when you divorce. Because, you know, people, I've had some people where they just go and refinance the mortgage. And then it's like, you owe the other person like $100,000. And, there's not like $100,000 to grab from somewhere else, like an investment account or a retirement account, or, some other place. And so then it's like, wow, like you have to refinance that mortgage again. And you just paid all those origination and et cetera fees. And and then the person who just refied is like trying to, well, how about, to the other person, how about I just, give you the $100,000, like $200 a month over the next, I don't know what, 50 years. So just just wait on refinancing the mortgage until you guys have a fairly good idea of how the assets are going to get divided, because then you're going to know how much more than the balance of the current mortgage that you need to get that new mortgage for.
That's an excellent point, Christy. It may not be that that you can't finance it or it's unfinanceable, but without going through the exercise beforehand, you won't know the most efficient way. So you could be wasting money, and nobody wants to waste money in a situation like this. So if you are the leaving spouse, this is something you definitely want to take care of, because you want to make, if you're not off the mortgage, your ex's late payment can hurt your credit. Now, I've also seen it go the other way, where a divorcing couple, the departing spouse may not have a lot of credit of their own, and they're still on a joint card, and that other partner's been making great payments and has a great credit history. So it actually helped their credit scenario. But I wouldn't count on that. Certainly wouldn't want to count on that. And remaining on the loan after you've departed, even if you've given over the title, that mortgage still can count against you on your next loan. So I want to give you an example of a case study that currently working on, is it involves a couple where they have a VA mortgage. So there's some unique scenarios with a VA mortgage. It is assumable, but if the mortgage is assumed and the lender buys and the lender allows it, or servicer allows it, it doesn't release the entitlement back to the veteran. And this is if the spouse is not also a veteran that use their entitlement. So it could affect their ability to buy another house until that loan is paid off. Now, sometimes with entitlement, there may still be enough entitlement there to get another mortgage with a zero down payment, but that's something that needs to be looked at beforehand. And the the VA loans generally have good rates, as with FHA. So it may make sense to stay with that particular loan, but you have to consider it in the context of everything else that's going on. If you have flexibility in other pools of money, where does it make sense to maybe pay off the equity from another pool of money? Because if you have a VA mortgage, like I said earlier, if you have a mortgage that you're assuming, that doesn't provide a mechanism for compensating for the equity that the departing partner may be expecting, or that is agreed upon. So it all gets back to planning. Make sure that the outcome that you want is supported by the method that you have available to you. And that's going to be different for every person based on their financial and economic situation, with employment, assets, and or support, if that's relevant. So if it's not done right, then the departing spouse, who is the veteran, can miss out on the opportunity to buy, a home again with a VA loan. So some of the mistakes you want to avoid is just assuming that your agreement or decree gets you off the loan. That is not an underwriting tool, and it says that you need to be taken off it, but it doesn't obligate the lender to remove you from the loan or remove the other person from the loan. That is a separate process, and the talking to the mortgage professional will help you define the roadmap. The divorce decree tells you where that map needs to go to. So the two separate processes, but they have to work together. So a mistake to avoid would be calling a lender only after you sign the divorce decree. So the next steps, where do you want to start? You want to know the numbers. What's your house worth? If you want to give me a call or send me an email to mmintz@execmb.com, that's execmb.com. I'll be happy to send you a estimate based on, we use a service from Canary, one of the leading home value estimators available. And we can test what you qualify for. Can you afford to buy out that loan? Can you afford to take it over? Or if you're departing, what will you be able to afford? So having a good understanding can give you a little bit more peace of mind in an already stressful situation. And That's about it. And there's so many things, so many aspects to dealing with a mortgage and a divorce and other aspects of finances divorce that don't just, I mean, use Chat GPT to get an idea, but talk to a professional. Absolutely talk to a professional because Chat GPT hallucinates, as we know, and it'll give you a framework for understanding it, but to understand how to exactly go about it, talk to a professional will get you set up in the right way and help you understand what's important to you and how to get there. And this is general information only. It's not legal or tax advice. And approval is always subject to underwriting.
There's some legal stuff in mortgages as well. There it was.
Yes.
And so Matt, can you kind of walk us through step by step, like how somebody applies for a mortgage? Because honestly, I mean, I've had like, I don't know, I think 8 mortgages in my life because I'm
Mhm.
old, but some people have not had a mortgage yet.
Sure. No, that's a great question. First thing you want to do is talk to a loan officer. Um, I would advise against going online to get a pre-approval. AI is great, but it doesn't fully analyze your situation and it doesn't necessarily ask you the right questions. So the first thing is to understand what is your current situation with your credit, how much of a house can you afford, and knowing what you want. And we'll take an application, look at your credit, look at your income, and determine what you can qualify for. And by qualify, they use ratios called debt to income, and that's looking at how much do you owe on your consumer debt plus the house that you want to buy divided by your gross monthly income. And that gives you debt to income. And the different loan programs, conventional or government, have different levels of risk or um, debt to income that they allow to be approved. And that's where we go from there. And then we find a realtor, or you bring your realtor, and we find property for you to make an offer on.
What types of documents are you going to need from your prospective clients?
That's an excellent question, Christy. So it depends on how you earn your income. If you're a W-2 employee, salaried, we need a recent pay stub from your current job and the last 2 years of W-2. Generally don't need a tax return, but it depends on the type of loan. Need your ID. And if you have any properties that you currently own, we'll need to see those mortgage statements and insurance and like multiple tax. It's basically to establish your income level. That's that's really the most important part of my job is determining the level of income because everything is driven by that. Now, if you're self-employed, I'll need to see tax returns, whether it's an LLC or a corporation. I'll need to see all the documentation on there. That's a little bit more involved to determine how much income you can qualify for. And as a wholesale mortgage broker, I have a lot more flexibility than a bank does in the types of loans that I can write and who I can work with, whether it's on a lower credit score or variable income. If somebody has variable income that is a bonus or commission or stipends, then it's a little bit more in-depth analysis of how much of that income we can use. Generally have to have 2 years history of commissions to be able to use that. Otherwise, just the base salary. So those are the types of documents that we need.
Awesome. Yeah, because if you haven't done something the first time, it's always scary. And the more
Mhm.
information that people have, the less scary it's going to be for them to reach out to you. Um, and what does a wholesale market mortgage company mean?
So wholesale mortgage versus retail means that I'm what's called a third party originator. If you think of it like a insurance broker, they don't work for like State Farm. They work for their own company, and they go out and find you the best policy for your scenario, whether it's Progressive, Geico, National General, Liberty Mutual, whoever it is, they'll go out and find the best policy for you. That's what I do with mortgages. So I'm regulated by the Department of Commerce in Minnesota, similarly in Wisconsin, where I'm also licensed. And we collect the application, we act on the borrower's behalf, but I work for them, not for the bank. That's the main difference. And we're cheaper.
That's very important that you work for the client, not the bank. And so if there was, one thing that you would want people to remember most about what you said today, what would it be?
Talk to me sooner rather than later. Whether you're buying your house for the first time or you're thinking about getting a divorce or wherever you are in the process, talk to the professional who deals with that area, whether it's mortgage or any other aspect, because we don't know what we don't know. And that goes for me as well. I'm not an expert in what you do, Christy. I'm not a financial planner, I'm not a lawyer, but on mortgages, I do know what I'm doing, and I can guide people to address those aspects and make sure that their other service providers address those aspects as well.
Oh my gosh, I just love that because yes, I would also like to hammer that point home because I don't want you guys to go get a mortgage, someone to refinance a mortgage, and then, we're in that terrible position of being like, so you have nowhere else to draw assets from to give the other person. So you're gonna have to refinance the mortgage again. Get all of your information about your, retirement funds, investment accounts from your financial advisor, your mortgage from a mortgage lender. Me regarding what do the law say about this, that, and the other thing. Get all the information from all the professionals and then start making decisions. Some decisions are very difficult to undo. And yeah, so great main point. And I am not seeing any questions anywhere for either of us. So if you would like a free consultation from either of us, our information is in the post for this Facebook Live event. Reach out. We would love to give you a free consultation. And
Absolutely.
since I'm a paralegal, not an attorney, I cannot help everyone. And so if you have a divorce case that I cannot help with, then I will refer you to some lawyers who I have vetted and are great and affordable. And because I want to make sure that people get the help that they need when they want to divorce and or handle a child custody case. And Matt, do you have any last words?
Just thank everybody for attending and reach out if you have questions. Laws change all the time. We have new laws in Minnesota now, not relating to this topic, but investment properties, new laws there on prepayment penalties, getting cheaper for potentially cheaper for investors. Reach out if you have any questions about that and ask those in the know.
That's right. The more you know. I hope that everyone in Minnesota has a great rest of this beautiful, pretty sunny summer day.